There are over 9,900 exchange-traded funds out there, and that doesn't even include the index mutual funds. Now, when you are looking for a long-term and low-maintenance investment strategy, I think ETFs are the best option because they allow us to diversify sufficiently and by that reducing the risk. At the same time, they still have a decent return and they also have low costs. So I went through my own notes because when I started to invest in those products, I did the research myself and again went through all the different platforms and some articles and also some other YouTube videos on the topic to find the best 10 ETFs to own for life. And let me tell you, it was a bit of a hassle. So let's take a look at those 10 best ETFs to invest in so that you can start right now instead of wasting time through going through all the different options yourself. Before I start with the first one, just some few heads up information. I will use index ETFs for this list so that no matter where you live, you can buy them over a stock exchange and that should be available worldwide. If you are with a specific investment company like Vanguard or Fidelity, you can also just take the name from the ETF and type it in that platform and then you can see what they have available. I'm pretty sure that all of them will have some version of the indices I use here. Just know that the conditions might be different. They might have other costs. You might need a minimum amount of money that you need to invest in, like $3,000. And also what's in the specific product might be slightly different. So take a close look of what's inside. Also for this list, I will use the name of the ETF and not the ticker symbol because the ticker symbols are different at every stock exchange. And that is why sometimes when you look them up on a search platform, you will find a list with all the different ticker symbols at the different stock exchanges. To be honest, it was a bit of a struggle to find products that are available within Europe as well as outside of Europe because Europe has this like special regulations for financial products. Just know that depending on your region, the ETF might look or sound slightly different. And finally, I'm not a financial advisor. I don't want you to go out and buy them like blindly without taking a closer look yourself first. It's supposed to be an inspiration and you can use it to find a starting point where to take your research from. And for that reason also, although this video is titled the 10 best ETFs, occasionally I will name more than one that you have a wider range to choose from. So let's begin. Number one is the Vanguard FTSE All World Index. That's an index which contains large cap and mid cap companies from all over the world. Just a quick reminder, cap is referring to market capitalization. How the market capitalization is defined actually depends on the issuer of the index. MSCI, for example, uses a market capitalization per percent. This then looks like this. So the upper 70% are considered large capitalization. The following 15% are considered mid capitalization. Then we have small capitalization with 14% and micro capitalization with the remaining 1%. Other issuers like the S&P use a number of companies instead. So the first couple of hundred companies are considered large cap and then the next couple of hundred companies are considered mid cap and so on. So this is a very broad index. It covers 49 countries all over the world, developed and emerging. There were over 3,500 companies in it and the biggest positions are Apple, Microsoft and Amazon. So the US version, or let me rather call it outside Europe version, will be the Vanguard FTSE All World ex-US Small Cap ETF. Ex-US small cap because, like I just said, it's large cap and mid cap, so they like excluded the small caps. And this one has an expense ratio of 0.08%. Wow. And the European version is the Vanguard FTSE All World UCITS ETF. UCITS stands for the, European regulations conformity. So every time you see UCITS, you're safe to buy it in Europe. And this one has a total expense ratio of 0.22% per year. If you want to own only one fund, this is a good choice. It's widely diversified, it's very low cost. I'd say you're doing nothing wrong with this one. And also an advantage with the one fund version is you don't have to rebalance, which means to balance out the proportion of the funds in your portfolio once a year. ETF number 2 in my list is, I would say, a pretty famous one in Europe, and it's the MSCI World. This one also contains large cap and mid cap companies from the developing world. from 23 developed countries. And there are close to 1,500 different companies in it. The biggest positions here as well are Apple, Microsoft and Amazon. Now internationally, I found the iShares MSCI World Index ETF with an expense ratio of 0.24%, and the European version, which I own as well, is the iShares Core MSCI World UCITS ETF with an expense ratio of 0.2% per year. I think this one is also a great choice. It's widely diversified, and if you want to lean more into the developing world, this is the better choice for you than the first one. Now I would say, because it's without the emerging markets, it's probably a little less risk than the FTSE All World, and also you have more control over how you want to allocate less risk and more risk, because when you have an MSCI World, you can add a second one or a third one as well, and you can define the proportion yourself. And that brings us to ETF number 3 in this list, and that is the MSCI Emerging Markets. Now I chose the iShares Core MSCI Emerging Markets IMI. IMI stands for Investable Market Index, and that means that this index contains large cap, mid cap and small cap from the developing world. It has over 3,000 different companies in it. The top 4 positions are Taiwan Semiconductor Manufacturing, Samsung, Tencent and Alibaba. At least one of them should sound familiar. If you don't want to have the small caps in your emerging market funds, you can also take just the iShares MSCI Emerging Markets ETF, which then is without the IMI. Both of those ETFs have an expense ratio of 0.18%. Now emerging markets is one way to add risk and therefore also higher potential return into your portfolio. The other way is through small caps, and that is number 4 in our list. And for this one I chose the MSCI World Small Cap. So this fund invests into small cap companies all over the world. It has over 4,000 companies in it from 23 developed countries. And the iShares MSCI World Small Cap has an expense ratio of 0.35% per year. To be honest, I'm not quite sure if this one is available outside of Europe. If you're in the US or somewhere else in the world, please let me know. And that's why I also looked up some alternatives, especially if you don't want to invest into a small cap ETF around the world, but maybe only in the US. For those, I found the iShares S&P Small Cap 600. A well-known small cap index is the Russell 2000. The difference is simply the number of companies that is in the index. And what I also found was the Vanguard Small Cap ETF. And if you're looking for a small cap ETF in Europe, I found the Spider MSCI Europe Small Cap UCITS ETF. And I have this one as well. Number 5 is probably the most popular ETF out there, and that is the S&P 500. That's a good one if you want to have a bigger regional focus in your portfolio. The S&P 500 contains the 500 largest companies of the US. I think the exact number is actually a bit over 500. And here I found the Vanguard S&P 500 ETF with an expense ratio of 0.03% per year. What? And for Europe, we have the iShares Core S&P 500 UCITS ETF with an expense ratio of 0.07%. Just so that I mentioned it here, in case you don't want to split large cap and small cap in the US, you could also go for the Vanguard Total Stock. The short symbol is the VTI, and it's the Vanguard entire US stock market. So then you have large cap and small cap from the US in one product. If you're still here, I would love if you could drop a like for the algorithm. Thank you. Number 6 in our list, if you want to have a regional focus on Europe, is the Euro Stock 600. This one contains the 600 largest companies in Europe. And here I found the Xtrackers Stocks Europe 600 UCITS ETF with an expense ratio of 0.2%, and also the iShares Stocks Europe 600 with the same expense ratio, 0.2%. So those first 6 were kind of like part 1, because those are the ones I'm most familiar with, because in one way or another I invest in them myself. And for all of those, and this is what I probably would recommend or at least consider for you too, I have an accumulating strategy. That means that all the dividends from the companies get reinvested immediately, and with that you max out on compound interest. If however you would like a distributing strategy where you earn a regular dividend income, my number 7 is a dividend fund. Now a few thoughts of mine before I tell you the fund that I picked. A dividend strategy allows you to create a regular income from your investments, and there are mainly 2 ways or options. Now the first one is to invest in single dividend stocks. And one popular way here is the aristocrats. An aristocrat is a company that has paid and increased their dividends over the past 25 years. And there are also dividend kings which have paid and increased their dividend over the past 50 years. Or you might simply go for a high yield dividend strategy because there might be companies that still pay a good dividend, but they've only done it for 15 or 20 years. Now the pro here is that you only pay the transaction cost when you buy the stocks over your broker, and the taxes on the dividend income if there is in your country. Now the con here is, as always with single stocks, is that you need time to research all the different companies. You might also need a higher amount of capital in case the stocks are expensive. And if you wanted to buy, for example, all of the aristocrats, that's over 70 different companies, and then you just lose overview because that's a lot of positions to have in your portfolio. And that is why the second option is to invest in a dividend distributing fund. Now that's simple because you only have one product and you get paid for owning that product. But, and that's a little but here from my side, is of course with the fund you have the total expense ratio. And this ratio will in a way diminish your dividend income. So that is one factor to look for, how much it costs, because costs are always an important factor for us. But especially if you want to earn money with it, you don't want to, have it reduced too much through the cost. And the other factor to look for is the equity yield or the dividend yield, which is basically how much dividend you get paid out. And if your focus is a regular income, you should choose this one as high as possible. But note that this is not a fixed rate, it changes yearly. Now there are obviously other funds that have a distributing strategy as well, but if your focus is to create a regular and relatively high income, I would go with a high yield dividend strategy, because what you get out of the other funds will not make such a big difference. So for this video, because it's an index ETF list, and I assume that you want to create a regular income and as high as possible, I chose the Vanguard FTSE All World High Dividend Yield. This one has over 1,800 high yield dividend companies in it from 10 different countries around the world. It has an equity yield, at the time I looked it up, of 3.9%. That's good. It's not terrific. I know of someone who is specialized in high dividend income, and I know that he has a goal of at least 5% in dividend yield. If you want to learn more about this specific strategy, let me know in the comments. But the Vanguard also has a total expense ratio of 0.29% per year, and that was pretty good. The other one I found was the Spider S&P US Dividend Aristocrats UCITS ETF. That one, at the time I looked it up, had a dividend yield of 2.2%, so less than the Vanguard, and an expense ratio of 0.35% per year, so still more expensive. And another one I found was the Spider S&P Global Dividend Aristocrats UCITS ETF. This one had a dividend yield of 4.24%, so higher than the rest of them, but also an expense ratio of 0.45% per year. So you can already see it's a bit of a balancing act between dividend yield and total expense ratio. So take your time to research so you get the most out of it for you. And now we are leaving the stocks and funds territory, and my number 8 will be a bond ETF. Now, to be honest, I really struggled with this one, and I want to tell you why so that you understand my thought process. Now, all the other products I mentioned up until now are products that I own myself in one way or another. I have not invested into bonds yet because first, I have a pretty long time horizon. Second, I have a pretty high risk tolerance. And third, I am in my wealth building phase. So I kind of want to max out my potential with stocks. And also, during the time that I started investing, the key interest rate was so low that bonds were not attractive as an investment class at all. But I wanted to include one into this list in case you have a shorter time horizon, or you have a lower risk tolerance, or maybe you're already a multimillionaire and you're looking for a way to preserve your wealth. And also, bonds have become a little bit more attractive nowadays because the key interest rate is rising, which means that we get also higher interest rates with bonds. Now, here's why I struggled. Bonds are actually a pretty complex product, and there are several aspects here at play. So the first one is the interest rate, and this one is actually fixed for the bonds, and obviously it matters because the higher the interest rate, the more we get paid. Second is you have the price of the bond, and this one isn't even that important if you buy a bond when it is issued and then you keep it for the whole time until maturity. But bonds are traded over the market as well, and that means the price fluctuates. And the price of a bond that already exists goes down when the key interest rates rise, and the price for a bond goes up when the key interest rate false. So if you intend to buy or sell bonds before maturity, this one actually matters for your return. The third one I already mentioned, it's the maturity date, because bonds always have a fixed time of how long the interest rate is paid. And the fourth factor is the rating. And the higher the rating, the highest rating there is a AAA. So those are considered very safe, and that's why they also can offer lower interest rates. And the lower the rating, the higher the interest rates, but then of course also the higher the risk. So with bonds in general, the question becomes, what do you want the bonds to do for your portfolio, and how long are you prepared to have the money locked up? Of course, it's not really locked up because you can sell them over the marketplace at any time, but you might not want to sell them for a lower price. So I assumed that you want to add security into your portfolio. And that is why I chose treasury bonds, because corporate bonds are considered riskier. And I also chose treasury bonds from Western countries with high ratings, because they are considered safer than, for example, bonds from the emerging markets. And I also chose one, or to be exact, two that are country or at least currency specific. So one for US dollars and one for euros, because currency in bonds actually matters. So here they come. I chose a Vanguard US dollar treasury bond ETF with a total expense ratio of 0.07%. That one is for the US. And an Xtrackers Eurozone government bond ETF with an expense ratio of 0.09%. This one is for Europe. Whew, this one was challenging. So before you buy them, please do your research and also let me know. All right. Number 9 will be a fund that invests into properties. Real estate is an important asset class when it comes to investing in general. I think it's also a popular asset class, I guess because it's easy to grasp and to understand. I mean, everyone understands a building. You're probably in one right now. But investing into single properties, so buying a whole house as an investment for yourself, is actually time consuming, it's money consuming, and it also doesn't allow for diversification. So a nice alternative to still invest into properties but without the hassle of buying one yourself is to invest in a property fund, and there's basically two ways. The first one is to invest into a REIT, a real estate investment trust. That is then a trust that buys the properties. And the second way is to invest in an ETF that combines several different REITs. And then it's not just diversified over different properties, but it's also diversified over different trusts. Now, I personally have a REIT, but you cannot buy them over every stock exchange. That's why for this list, I chose the Vanguard Real Estate ETF with an expense ratio of 0.03%, and this one has several REITs in it. And for the final number 10, I decided to go back to stocks because maybe you are someone for whom environment and sustainability and also social aspects of companies are important. And that is why I chose an ESG conform ETF as my number 10. ESG stands for environmental, social and governance, meaning they invest into companies that have committed to protection of the environment, social responsibility and or transparent governance practices. Now note, they don't have to cover all three of them. If they cover one of them, that's enough to be considered ESG. And I chose the Xtrackers MSCI World ESG with an expense ratio of 0.2%. If one particular aspect is important to you, for example, there are also ETFs for clean energy, you can take this one as a starting point to do further research. The next step for you now is to look up the ETF that interests you the most and compare this one to alternatives. And in order to do that, you might want to know what criteria to look for. Then you can watch this video next where I go through my process of picking an ETF. Thank you for watching, happy research, and I see you in the next video. Bye bye.